What's up guys, Ben here and welcome to Motivation to Invest. Ray Dalio is one of the greatest investors of all time. He started Bridgewater Associates in 1975 from his apartment, which has now become the world's largest hedge fund with over $160 billion of assets under management. He's a firm believer in market cycles and has predicted many of the previous stock market crashes. So I'm sure you'll agree there's a lot we can learn from this great investor. So in this video, I'll be diving into the portfolio of the great Ray Dalio and revealing his top 10 funds. So if you're ready to discover what Ray Dalio has been buying and see if his stocks are right for you, then let's dive in. Welcome back guys to Motivation to Invest. Before we get started, go ahead, smash that like button for the YouTube algorithm. That allows us to continue creating more great content like this for you guys. In addition, if you would like more investing tips and exclusive stock market picks, which I personally have invested into, then you should definitely subscribe to this channel. Be sure to turn the notification bell on. That way you'll get notified when I release future stock picks. With that being said, let's get into the video. Diving into the portfolio, we can see it's heavily diversified, both internationally and across a variety of asset classes. So as you can see here, checking out the fund's performance, it's actually outperformed the S&P 500. So it's effectively beat the market over the past 5 years. So the S&P 500 had a total return of 55.84%, and Ray Dalio's investment portfolio had a return of 73.67%, so it's vastly more. This is Ray Dalio's style. He likes low risk, high reward, and heavily diversified. And if it's good enough for him to manage $160 billion worth of assets, then it's good enough for you guys. So diving into the top holdings here, the first holding, which makes up 18.2% of Ray Dalio's portfolio, is the SPDR S&P 500 ETF Trust. Now the S&P 500, I'm sure you all know, is the 500 largest and best performing companies in the USA. These include the prestigious FANG stocks such as Facebook, Amazon, Apple, Netflix, and of course Google. The SPY is a heavily traded ETF, which was formed back in 1993 as the first publicly listed ETF in the USA. The main difference between the SPY fund and other S&P 500 funds is that the SPY tracks the S&P 500 in real time. Thus it's popular with traders and it's got a high amount of liquidity. However, for this increased accuracy, you do pay a slightly higher expense ratio of 0.09%. You've got a yield, dividend yield 1.9%, 3-year past performance 10%, 10-year past performance 13%, annual returns. So it's got some interesting annual returns. So in the years of 2013, 32% return within 1 year, 2017, 21.69%, 2019, 31.29%. So it's had some great returns in the past, of course, mainly due to its top 10 holdings. So you've got Microsoft, Apple, Amazon, Facebook, Alphabet, which is the parent company of Google, Johnson & Johnson, Berkshire Hathaway, Warren Buffett's investment firm, Visa, another great stock, and JP Morgan Chase. So these are fantastic stocks, and mostly the FANG stocks, the big tech giants. That's what gives the S&P 500 such a strong performance. So the second largest holding in Ray Dalio's portfolio is, of course, gold.
Buffett won't touch gold.
Mm-hmm. Okay, yeah.
You think he's wrong? Well, clearly you must.
I think he's making a big mistake. Yeah. Gold is like cash. It's an alternative version of cash. So over long term, it's not the best investment. Over long term, it's a little bit better than cash over long term. It is, however, when you're having a monetary crisis, when you have a fiat monetary system, and you have the need for money. Debt is a promise to deliver money.
Right.
So if you look at each of those devaluations that have taken place, March 1933, President Roosevelt closes the banks and then opens them and says you can get your money. And then they broke the link with gold. And so the history over that period of time is that money can be produced. Gold is somewhat limited. It's an effective, it's an alternative that should be part of everybody's portfolio, but not in a big way.
With the economy in deep freeze, governments from around the world have printed trillions of dollars worth of currency to stop things falling apart. From $65 billion in the UK to over $2.3 trillion in the US being released as stimulus packages. Now, although this may seem great in the short term as a way to prop up the economy, in the long term, this money has got to come from somewhere. In the past, when vast amounts of money was printed and pumped into economies, this led to hyperinflation, which happened in Germany during the 1920s, and more recently in Venezuela. This is where the value of paper currency effectively goes to zero. Now, gold has always been a natural hedge for investors during recessions, but in these times it seems as if it's shining even more than normal. Many great investors think gold is not just a safe bet, but could increase to over $10,000 per ounce. This is the SPDR Gold Trust, or GLD, which makes up 11.9% of Ray Dalio's portfolio. So let's look at the details here. We all know Ray Dalio loves gold. So gold was actually predicted to go to $10,000 per ounce. To put that into perspective, today it's currently at 1,500 euros an ounce, approximately, say $1,500, $2,000 an ounce. So you can easily see 10x increase in the future. That is what many people are predicting. Whether that will or won't happen is another story. With regards to this specific gold ETF, it says it offers investors innovative, relatively cost-efficient, secure way to access the gold market. Originally listed on the New York Stock Exchange in 2004, SPDR Gold Shares is the largest physically backed gold exchange-traded fund in the entire world. It's on all the major stock exchanges. They've also got mini shares, which offers one of the lowest available expense ratios. So that's SPDR Gold Mini Shares, which is another option for you guys out there. A lot of the investors recommend at least 5% of your portfolio should be gold.
Gold. Never own the miner, own the gold.
You think physical gold?
Yeah, well, here's what I do. I own physical gold for 50% of the position, so 2.5% weighting. And I use the GLDs, which are an American U.S. pay or U.S. currency, product. And then I, supposedly own the physical gold that way. But what I like about the GLD is I can trim my weighting every month. So when it gets over 5% weighted, I ping off a few GLDs or I buy in the GLDs. Right. Physical gold, I go hug at night.
Right.
I personally wouldn't really go over that, to be honest, as it just, as Warren Buffett says, it doesn't produce anything, which is one of the main negatives of gold. It's more of a hedge against recessions and against inflation.
A broader example than that. If you buy an ounce of gold today and you hold it 100 years, you can go to it every day and you can coo to it and you can caress it and you can fondle it and 100 years from now you'll have 1 ounce of gold and it won't have done anything for you in between. If you buy 100 acres of farmland, it will produce for you every year. You can use that money to buy more farmland. You can do it, all kinds of things. For 100 years, it'll produce things for you, and you still have the 100 acres of farmland at the end of the 100 years. You could buy the Dow Jones Industrial Average for 66 at the start of 1900. Gold was then $20. At the end, it was 11,400, but you'd all gotten dividends for 100 years. So a productive asset of any kind, a decent productive asset, is going to kill a non-productive asset over time. Now, in any given 1-year period, 5-year period, any asset can outperform another asset.
Right, so that's gold. On to the third largest holding of Ray Dalio's portfolio. We have the Vanguard International Equity Index Funds, or the Vanguard FTSE Emerging Markets ETF. This makes up 9.2% of Ray Dalio's portfolio of 2020. So this obviously includes a large exposure to emerging markets. Firstly, what is an emerging market? Because this term gets thrown around a lot. So the top 7 emerging markets in the world are currently China, India, Brazil, Russia, Mexico, Indonesia, and Turkey. So what are the characteristics of emerging markets? They're going through a period of industrialization, experiencing above average economic growth. They have fast-growing populations and an emerging middle class. Their currency tends to be exposed to more volatile swings, with currencies of advanced economies, particularly the US dollar. They also tend to be vulnerable to swings in commodity prices like oil or agricultural goods. They are attempting to introduce greater accountability and transparency into the economy and financial system to build confidence among foreign investors. So that's emerging markets for you. So diving into the specific fund here, we've got the Vanguard FTSE Emerging Markets, or VWO. So this fund invests in stocks and companies located in emerging markets around the world, such as China, Brazil, Taiwan, and South Africa. Goal is to closely track the return of the FTSE Emerging Markets All-Cap China Inclusion Index. It has high potential for growth, but also high risk. Share values may swing up and down more than that of stock funds that invest in developed countries such as the US. So it's a more volatile fund, but with the potential for higher rewards. Only appropriate for long-term goals. That's what it says here. This is the advisory by Vanguard. Let's look at so it's got an expense ratio of 0.1%. Top 10 holdings. So it's got Alibaba, of course, you know, the largest e-commerce platform in China. Then you've got Tencent, also another tech mammoth of China. Taiwan Semiconductor Manufacturing, China Construction Bancorp, Naspers, Ping An Insurance Group of China, Reliance Industries, Industrial Commercial Bank of China. So yeah, very volatile performance over the past 10 years. So it says growth of $10,000. You'd only have $12,700. So you wouldn't have a massive amount because this has been just so volatile over the past few years, up and down, up and down, up and down. So it's not been the best performing fund historically. However, that doesn't mean it couldn't be a great performing fund in the future, especially with the talk of China becoming the new superpower of the world and overtaking the US. 42.8% in China, 16% in Taiwan, 9.7% India, 5.5% Brazil, 4% South Africa, 3.4% Russia, Thailand, Saudi Arabia, Malaysia, Mexico. Nearly half the fund is in China, and then, of course, around Asia, also Taiwan. To me, a strong benefit of this fund is if you want some exposure to the Chinese market, but you're not sure which specific companies to invest in, then this ETF could be the one for you. Onto the 4th largest holding of Ray Dalio, we've got the iShares Core S&P 500 ETF, IVV, 6.6% of the portfolio. Now, this is very similar to his largest holding, the S&P 500 ETF Trust. It's most likely got a slightly lower expense ratio, and I'd say that's probably the only major difference because they both track the S&P 500 ETF. Its next largest holding, we've got the iShares 20+ year Treasury bond ETF, 5.5%. Now, Ray Dalio is a strong advocate of having a percent of your portfolio in bonds, as it's a reliable hedge against market crashes and adds as a ballast to your portfolio. These are high quality bonds. You've got backed by the Treasury, of course. Another fund here, iShares iBox, an investment grade corporate bond ETF, 4.5% of the portfolio. Right, guys, so on to Ray Dalio's 7th largest holding. We have the iShares MSCI Brazil ETF. Now, as stated earlier, Brazil is an emerging market and one that I think every investor should get involved in. But the difficulty can be finding the exact companies to invest in Brazil. And that is where this ETF comes in. So it gives you exposure to large and mid-sized companies in Brazil, targeted access to the Brazilian stock market. Used to express a single country view. So of course it gives you large exposure to the Brazilian market. Now, previously it's not had amazing return. It's actually -8% over the past 10 years, which isn't great, but that doesn't mean it will not increase massively in the future. And that's the volatility that you get with investing into emerging markets. Number 57 holdings, so it's not got a massive amount of holdings really, which makes sense for the volatility. P ratio 11.88, which is a good PE ratio. Price to book ratio 1.8 on average. The fees of this fund, you've got a 0.59% management fee, and which is also the expense ratio. Right guys, so diving into the top 10 holdings of this Brazil ETF. Now my Portuguese is extremely bad, so if you guys know the correct pronunciations for any of these companies, then please do drop that in the comments below. But let's dive in. The largest holding in this Brazil ETF is a company called Vale Materials Company, and it's basically the largest logistic operators in Brazil, one of the largest, and engaged in the metals and mining industry. So it's also the largest producer of iron ore and nickel in the entire world. In addition, it operates 9 hydroelectricity plants and a large network of railroads, ships and ports used to transport its products. 9th largest holding is a company called Unibanco. So this is the 10th largest bank in the world by market value and is the biggest Latin American bank by assets and market capitalization. The 8th largest holding is B3 Brazil Bolsa Balco. Now this is the Brazilian stock exchange. So that makes up a large portion of the holdings in this ETF. You've also got a few more banks on there, Banco Bradesco. Let's look at a few details of this bank. So this is the largest private bank in Brazil. And then you've also got a couple of petroleum companies here, Petroleo and Petrobras. So yeah, the interesting thing about this fund is that it's a large amount of sort of old school companies. You've got large mining companies, large banking companies, large energy companies. For example, the S&P 500 in the US, which is mainly, you've got a large portion of sort of tech companies which dominate that index. So the last few here, we've got another gold trust. So iShares Gold Trust IAU, which makes up 3.5% of Ray Dalio's portfolio. He does love gold. So at number 9, we've got the iShares MSCI Emerging Markets ETF. Let's dive into this a little bit more detail. So the IEMG gives you low-cost, comprehensive access to stocks in emerging market countries, used at the core of the portfolio to diversify internationally and seek long-term growth. So this is another one that's not done really well in the past few years. So over the past 5 years, it's down approximately 1%. Obviously, given the current economic conditions, maybe it was up in 2019. It's hard to tell from this graph here. Let's look at the portfolio characteristics. P ratio 13.97. Fees, only an expense ratio of 0.13%, which is very good. Top holdings, you've got Alibaba Group, which is top holding, Tencent, Taiwan Semiconductors, Samsung, China Construction. So yeah, it's generally a large exposure to the Chinese market. I personally have shares in Alibaba. I also believe Tencent is a fantastic company. So they are great companies to invest in if you want to invest in the stocks individually. But yeah, on to the 10th largest portion of Ray Dalio's portfolio is the iShares iBox High Yield Corporate Bond ETF, which makes up 2.3% of the portfolio. So right guys, there you have it. That's Ray Dalio's portfolio. It's got a variety of funds, both internationally diversified across a variety of asset classes. Now, to me personally, that's a great fund if you've just got a large sum of money and you just want to put into a safe fund which will grow over time, then that's the fund for you. It's very well protected. You've got a lot of bonds in there. You've got exposure to gold and you've got exposure to the emerging markets, which could increase massively in the future, thus increase the portfolio. And then you've got the stability offered by the large growth companies of the S&P 500 with the trusts in there. So what do you think of the stocks Ray Dalio has been buying? Comment your thoughts below. Also, if you found this video informative, please smash that like button. That really helps us out with the YouTube algorithm. And with that being said, I'll see you guys next time.